Good afternoon. Today I would like to talk to you about the Chinese banking sector and the influence of the government over its operations. But let me start by talking to you about the different classes of banks that are currently operating in China. First, the policy banks or state-owned banks. Wholly state-owned banks dominated the industry for many years. Those banks are the Chinese Construction Bank, the Agricultural Bank of China, and the Export and Import Bank of China. Each of these banks have different missions. For instance, the Agricultural Development Bank of China is to provide support to the agricultural sector and to aid the growth of the rural areas. The China Development Bank is responsible for raising capital for large infrastructure projects and to have a diversified portfolio of investments to raise capital. The most important goal of the Chinese Exim Bank, or the Export and Import Bank, is to fund the Chinese exporting industry and to ease the import of technology into China. Each bank has a board of directors that has been selected by the government, and they report directly to the State Council, which establishes the bank's operational priorities. These banks function financially by either receiving capital input from the central government or by issuing bonds. The bonds issued by these agencies are presumed to be government insured and allows them to raise capital at a relatively low price. Second, in the early 2000s, the Chinese government initiated a conversion of the wholly state-owned banks into joint stock corporations and called them equitized banks. Those banks were set up to act more as commercial banks instead of government agencies. The equitized banks are owned by a diversified number of stockholders. Shares of ownership to this type of banks are majorly owned by the People's Bank of China, the Chinese Ministry of Finance, or other type of government's own agency. This gives the government most of the agency's control. But the stock shares of equitized banks are sold also on the Chinese stock markets, only to qualified foreign investors and Chinese private investors. After the change, equitized banks have diversified functions, such as the corporate and personal financial services and overseas investments. Third, the local bank class. These banks were established by municipal governments and were fully owned by the government but have slowly been transformed into joint stock companies where the local government is the largest stockholder. An average of 18.5% of the locally owned banks' shares are owned by the local governments and other Chinese banks or corporations. The rest are owned by a restricted amount of private or foreign investors who have to be approved by the government to be able to own the shares. This process began in 2004 with a 3-year plan to open 1,300 new rural financial institutions from 2009 to the end of 2011. The banks were created to handle locally created projects and locally owned programs. Because of the size, they usually struggle to compete with largest entities as the ones mentioned previously. But local governments usually choose them for local projects instead of larger institutions, and as a result, these smaller banks have a competitive advantage in this area. Fourth, Chinese private banks. They exist in two forms: Chinese-owned joint stock banks and foreign-owned banks. The largest joint stock commercial bank in China is the Misheng Bank. This bank was established in 1996 and was the first of its kind, and majority of its shares were actually owned by private or non-governmental entities. Since 2010, 37 foreign banks, 2 joint venture banks, and 1 foreign-owned finance company have entered the Chinese banking sector with a sum of about 270 branches. Furthermore, 90 foreign banks have established presence in China by operating branches there. This has resulted in about 360 foreign-owned establishments currently working in China, with presence in 45 cities and 27 provinces, and with an estimated assets of about 274 billion, or 1.83% of the total Chinese banking assets. Even though the foreign presence in the Chinese banking industry is increasing, it has not been easy to enter this market. Any foreign bank that wishes to incorporate their services are required to have a minimum registered capital in China of $157 million plus $14.6 million for each additional branch or office. Additionally, regulators require that locally incorporated banks preserve a 75% loan-to-deposit ratio by the end of 2011. Legal entities that participate in the Chinese banking sector are regulated by the government and have to report to the People's Bank of China, which is the Central Bank of China. The central bank reports directly to the State Council, and they stipulate the implementation of the monetary policies. They regulate the issuing of money and its circulation. They regulate the interbank lending. Furthermore, it administers the public foreign exchange market, regulates the interbank foreign exchange market, and it regulates the gold market. It also holds and manages official foreign exchange and gold reserves. And as the chief of the monetary policies, the central bank applies changes in the bank's reserve requirements as a signaling tool to tighten or loosen the lending and the money supply. The strategy is similar to the expansionary monetary policy used in the United States, and its purpose is to lower the price of the country's currency to stimulate the economy by lowering imports and increasing the exporting of goods. After the Asian financial crisis of 1997, the Chinese government actually created the Chinese Banking Regulatory Commission. The Chinese Banking Regulatory Commission is responsible for the supervision of the Chinese banks, also ensuring that they are complying with the relevant laws and regulations and that the interests of depositors and the consumers are protected. Its principal functions are to authorize the establishment and business scope of banks in China, formulate and enforce banking regulations, audit and supervise all banks operating in China, and compile and publish information on China's banking sector. The Chinese Banking Regulatory Commission sees excessive deregulation as poor strategy and are in fact very cautious about following the US banking practices. On the other hand, they see their own policies as responsible for the rapid recovery that the Asian economy had after the global crisis. The top priorities of the Chinese Banking Regulatory Commission for 2012 were to defend the bottom line, improve risk control systems, strengthen external supervisions and internal controls, deepen financial reforms by speeding up product and service innovations, promote economic reconstructing, and closing down illegal financial services. The Chinese sole authority for the financial sector was the Ministry of Finance. This regulatory agency has steadily lost its authority over the course of the development of the new economic reforms. Its main functions are to formulate and implement the Chinese fiscal policies, prepare and administer an annual budget, propose and collect taxes for the government, prepare plans for the issuing of treasury bonds and other forms of government debt, formulate and implement accounting regulations for the businesses, collect data and conduct research on the economic and fiscal situation. Another regulated agency is the State Administration of Foreign Exchange. This agency was created in 1978 and reports to the State Council and People's Bank of China. Its main responsibility is to manage the foreign exchange of China, including maintaining balance of payments, regulating and supervising foreign exchange transactions, and the foreign exchange reserve. The agency must approve the outlay of any Chinese foreign exchange and overseas transactions. The Chinese government has placed the previously mentioned agencies to limit market access from foreign banks. The Chinese regulators have eased the policies to enter the financial sector, but not enough to comply with the WTO obligations. The foreign banks have not been completely allowed to provide full financial services in China, and for example, foreign banks are not allowed to provide auto loans of any kind to any individual. Moreover, foreign equity ownership has been limited to 25% or less of any Chinese subsidiary. The requirements placed by the Chinese government for the foreign banks to be able to provide financial services in Chinese currency are qualified as over-restrictive, and the processes of obtaining the approval to open a new bank or branch are very slow and sometimes impossible to comply with. Regardless of the partial privatization of the banking sector, China's government maintains tight control of many of their operations. The government especially exerts a strong influence over the lending practices and administration of the banks. in order to conform with government policy priorities such as helping small and medium-sized businesses and or slowing the growth rate of credit in China. The board of directors of the banks and senior bank officers are generally appointed by the Communist Party Organization Department, and most of them have been officials of either of the central government or agencies that are or were part of the government. Also, the central government applies direct pressures on financial institutions to finance specific projects that will only benefit the government or the Chinese economy. In the 2008 crisis, the central government of China was trying to boost the economy by pumping more credit into the market, and at the same time, banks were reminded to avoid non-performing loans and were cautioned about offering credit to companies that were poor performance. The government has placed a list of rules that regulate how banks operate, and the list includes a prohibition on shareholder interference of the operations of the bank, a ban on providing shareholders with preferential loans, rules governing the nomination and election of directors and supervisors by shareholders, rules defining the duties of the board and senior management, a requirement for the bank to establish a risk management department, a requirement that the bank uses an external auditor, the requirements for the performance evaluation and compensation of directors. Furthermore, the regulation agency has issued notices and guidelines designed to promote the management of banks to be based on a risk versus return assessments and utilizing the best international practices. The relationship between the banks in China and the Chinese government is based on striving to balance the goals of the bank to earn profits and to expand their operations, with overall economic policy objectives stipulated by the State Council and the People's Bank of China, plus other government agencies. Although the government continues to hold significant influence over the financial sector, the banks are no longer an extension agencies of the government. Most Chinese banks have established relations with foreign banks to perform more as commercial institutions and are less regulated than before.